All right, so these are the indicators we're going to be using, just two very simple ones, the 50-period simple moving average, which we use in just about every technique at specialist trading, and then an outside day bar pattern. This is a 2-bar pattern, okay? Now, when we say outside day bar pattern, you can use this on daily bars, you can use this on intraday bars, it doesn't matter, but we're going to teach you by showing you some older charts on daily bars, but then we'll show you some current examples where we go down to 5-minute time frames, we even go to a tick chart time frame. So even though it's an outside day, we'll say outside day, it doesn't have to be a daily bar. It can be a weekly bar for all we care. All right, so for those of you who aren't familiar with what a outside day is, it's a 2-bar pattern. All right, outside days are days where the chart bar is both higher and lower than that of the previous day. Okay? I'll say that again. You may want to write this down. Outside days are days where the chart bar is both higher and lower than that of the previous day. Okay? Now, let's show you exactly what we mean. These are two examples of outside days. Now, here's where most students of mine get confused. They say, well, Steve, do we have to close at the high or close at the low? It doesn't matter. We're not concerned where the bars close, either of these. Okay? These are two examples. We're not concerned with closes at all or opens. So it doesn't matter if you're looking at a range bar. It doesn't matter if you're looking at a candlestick bar. All we're concerned is that we have a 2-bar pattern here, as you see. And the second bar is bar number 1 and bar number 2. Its range from top to bottom exceeds or overshadows the range of the previous day. That's it. That's called an outside day pattern. Doesn't matter if it closes at the top. It doesn't matter if it closes at the bottom. It doesn't matter where the previous day's close or open is. Okay? So don't get confused or don't worry about where the closes are. We're just concerned that we have 2 bars and that the second bar in that 2-bar pattern, its range is totally higher than the previous bar's high and totally lower than the previous bar's low. Okay? So that is an outside day. And then once again, it doesn't even have to be a daily bar. This could be a 5-minute time frame we're looking at right now. It could be a weekly or a monthly. But that's what we're looking for, this specific pattern. All right, so how is this technique implemented? All right, now we know that we're going to look for that 2-bar pattern, and we're also going to apply a 50-period simple moving average. Well, what do we do? I mean, how do we use this? Look for either bar. Remember, either the first or the second bar in that 2-bar pattern of an outside day pattern to touch the 50-period simple moving average. All right? So one of those 2 bars, one of them must be touching. Doesn't matter if we close above or below, but just one of them must be touching. If both are touching, that's fine. But one of those in that 2-bar pattern must be touching the 50-period simple moving average. This is your signal that a short-term trend may be underway. That's it. Doesn't get any simpler than that. Don't have to figure out all these crazy ideas of what the Fed is saying or what's going on economically or what someone is saying in a chat room. Just listen to what the market is telling you. All right? So let's look at some older charts just for educational purposes and see how this works. This is an older chart of the British pound. And looking at this on hindsight, we would say, well, there's really no clue here as to what the British pound is going to do. We're kind of going sideways. And you can see here we have the 50-period simple moving average. And price is just oscillating above and below in a range. So someone right here would say, well, I'm not going to do anything. This market's not giving me any insight. I don't have any idea what's going on in the British pound. But if you learn how to listen to the market, you would see that there was an outside day pattern right here. Okay? We have bar number 1 and bar number 2. Bar number 2's range exceeds the range of the previous bar. And the second bar is touching, intersecting the 50-period simple moving average. So according to this technique, it's telling us the market itself is giving us a great clue that most likely there's going to be some short-term trend change or some trend is about to take place. Okay? And then look what happened. In the next 3 to 4 weeks, we had nearly 500 or 600 pips to the upside. Here's another example in the euro-dollar. This is an older example, once again, not current, but just for educational purposes. Once again, someone could be looking at this chart and say, well, there's really no clear idea or view as to what the euro is going to be doing. We're oscillating back and forth. But if you learn how to listen to the market and keep your trading simple, don't listen to the outside influences of news or of all these different trading rooms, but just listen to the market. Learn how to watch the chart. You'll see that we have an outside day pattern right here. Here we have 1 and 2. The second day's range exceeds the first day's range. And both bars are touching the 50-period simple moving average, okay? And then we see a couple of days later, same thing. We have another one. Okay, so right now the market is giving us two clues that there's most likely a trend change coming. Before any news came out, before anyone announced something, before any support was broken or met, it doesn't matter. And then look what happened, 800 pips to the downside in the next month. All right? Now, someone would say, okay, this is great, Steve, but wouldn't it be better if we kind of had an idea of what is the trend direction or which, clue as to which direction it's going to go? Yes, and the market is also giving you a clue. Let's look back at our examples here. And first of all, here's how we're going to fine-tune it. If the high or low of the outside bar, that's the second bar, that's the one whose range exceeds the first bar. If the high or low of that bar is exceeded on the next bar, so regardless of the high or low is exceeded, then the trend will most likely, not guaranteed, but most likely continue in that direction. So that's your clue as to which direction it's going to go. Let's look back at those examples again. Here was the British pound. Here's the two-bar pattern. Okay? So we know that there's a big chance, not for certain, not guaranteed, but there's a really high probability chance that there's going to be a trend change. But which way? Well, we wait for the next bar to tell us, because the next bar either has to trade above this bar's high or below this bar's low, and that's going to give us the clue. But it has to be on the next bar. Well, we see that the very next bar exceeded the range of the top, okay, of the high of that previous day's range. Doesn't matter where it closes, once again, doesn't matter where it opened. All that matters is that it traded 1 pip higher than the previous bar, or 1 pip lower, depending on what happened. In this case, it traded 1 pip higher, so right off the bat, before any news was announced, before any support or resistance was broken, before anyone said in their trading room, here's what I think is going to happen to the British pound, the market was telling you we're most likely going to have a trend change to the upside. And that was your clue. Okay? So while we were giving us these clues, while the market was giving us these clues, you could have started formatting your strategy to look for buy signals in the British pound. You were that much ahead of the game. How about the euro dollar? Remember we originally said, well, we have a couple of signals here. Well, we didn't exceed anything here, so the market didn't give us any clues. So that's why no action was taken. We really didn't have any idea, because on this bar following, nothing exceeded the high or the low. But then on this particular outside bar pattern, well, what happened? If we look at the higher range and the low range of the euro dollar on that second bar, we see here that the low was exceeded. So right off the bat, we now know that the euro dollar is giving us a really clear clue that we're most likely going to have a trend to the downside. And while it was starting to head, just while it began to go lower, you could have started looking for ways to short the euro dollar. Okay? Didn't have to listen to any news, didn't have to listen to any announcement. Why? Because the market told you in advance. All right, so let's look at some current technique examples using multiple time frames. We showed you some older examples just so you could understand the process. I'm going to show you some current technique examples, and these are examples that have happened anywhere from the last month or so to the last couple of days. All right, here's the British pound going back to just a couple of weeks, the 26th of June, and this is on an hourly chart. We see here that the British pound is just pretty much going sideways, nothing much is happening. And what do we see here? We have an outside day pattern. Even though it just is on an hourly chart and it just pretty much exceeds the range of top and bottom by a little bit, it still meets all the requirements. And guess what? On the next bar, we exceeded it. So at this point right here, the market was telling you that most likely we're going higher. So you should start looking for buy setups. It doesn't mean that you should just jump in and buy at the market. This is not a strategy. This is not a trading system. This is simply a technique to identify the current trend change. That's all it is.